In Bank Nifty, no doubt we are seeing higher value area and last point of demand is also moving higher. But when we look at trade facilitation, that creates some doubt to go with upward bias. Yeah, absolutely. So that's why I said that it's not a trade recommendation. The same distinction, I will make. Directional movement and directional bias are two different things. The trade facilitation is poor, and that should keep you away from trades demanding directional movement. Poor trade facilitation will affect these trades. They will not affect trades taken based on the directional bias because since you're not interested in directional movement, all you're interested in is okay, there is a certain level below which I don't want the markets to go because the directional bias is up. And I have put that level where, if I go to this chart, this is the last point of demand, and I have put my short strike at this level. So before it hits my short strike, it has to confirm that yeah, at least in the short term, it has changed the directional bias. Whenever you are saying that the trade facilitation is poor and you're not getting confidence of taking a trade from the long side, it's because you probably are thinking about directional movement, or you are thinking about strategies which require directional movement. But if you're looking at strategies which don't require directional movement, just the directional bias, then it will not cause any anxiety to you. I have faced this problem for a long period of time. You take a trade here, always. This is the last traded price. If you look at it in terms of the graph, okay, price graph, you are right at the edge. This is the, and somewhere vertically will be the current price, somewhere on this line will be the current price. So you're always trading on that red dot, this red dot. This is the worst place to take a trade. Where you have to take a trade is, if you want to improve the peace of mind, away from the last traded price. So I took a position on this day and the price was here. The price was somewhere here, but my trade is down here. There is a big difference in the two. And why I have kept this difference is because I am betting on directional bias. But I can completely understand your situation if you are feeling worried and finding it very difficult to make up your mind because this is absolutely impossible to understand like what the direction the market will take. But if you just zoom out a little and then look at where the value is forming, where the value is moving, the value is clearly moving higher. Trade facilitation is poor. So what? We'll get an inventory adjustment break. Now, if that inventory adjustment break goes below this 38,900, then we have to start thinking about opposite side, because then in that case the directional bias on the short term at least changes. And where is the level where the higher time frame directional bias changes? It is at 38,000. Even if I had this position and market came in this situation, I would have rolled it down. I would probably have established a bearish credit spread in the short term. And the moment it starts trading below 38,000, then for me the longer term directional bias has turned down, and then my primary position will be bearish credit spreads. And in case I have to make some adjustments and this and that, I will use bullish credit spread if required, otherwise not. So this is how if you trade, then you won't have that anxiety and that stress of taking a position because you won't be betting on directional move. So this point is the nemesis of traders, all right. This last traded price, last traded time, that is the worst place to trade or be if you are in a position. So that is why I don't really like debit spreads also, because in case of a debit spread you are always hooked on to the hinge to that last traded price and time, because unless and until it moves above your short strike, you're not going to make the profits that you are planning to make. So that is the reason why I don't like those kinds of strategies. But again, my objective is income. It's not capital appreciation or quick capital appreciation, and that is the reason why I am happy with these strategies. But if your objective is quick capital appreciation, then you have to be on the edge. You cannot avoid it. In that case, you have to be on the edge and you have to pay the price of trading on the edge.